Nvidia shares climbing higher once again today. The stock soared yesterday, adding $327 billion to its market cap. It was driven higher by strong results from competitor AMD. Now, despite the recent rally, though, Nvidia shares are still sitting roughly 13% below their all-time high. Joining us now for where Nvidia and some of its competitors are headed, we want to bring in Stacy Ragson. He's Bernstein's managing director and senior analyst. Stacy, it's great to talk to you again. So it looks like a lot of that excitement has now returned. I'm curious, do you think there's been just this shift in sentiment following AMD's results that we got yesterday?
So I don't actually think it was about AMD's results. I think it's about the capex guides we're seeing from lots of the hyperscalers, Microsoft and Meta and Google. All of those capex outlooks look very supportive. Like we're starting to see those numbers continue to go up. And I think that's what's been driving the AI trade. I actually don't think really it was AMD's results. AMD's results were not bad necessarily. They took their own AI guidance up a little bit, but I don't think they took it up any more than people thought they were going to. I don't think it was above where people thought.
So Stacy, then given that capex guide that we are getting from some of these hyperscalers, what does that tell us just about the opportunity, the upside here that we are potentially seeing for these chip makers?
Well, I mean, look, for companies like these, I mean, some of the numbers are very large, right? As you're looking forward in terms of where expectations are. And you know, the hyperscalers, they're big customers. They're doing a lot of that spending. And so you do want to see those numbers go up. This was a concern if you go back, I don't know, a quarter or two ago. There was a big mismatch at that point between like where the capex outlook was at the time and a lot of these AI names. And we've continued to see the capex guides actually go up materially. I think even Meta reported last night, and not only did they take their capex guide for the year, they said that they're going to have like probably substantial increases next year. And so I think that's really what's important. The big worry that people have is just, is there an air pocket like coming? There's so much spending going on. The numbers have gotten so big so quickly. People worry about sustainability. And what we've been hearing from some of the customers is it looks like that spend, at least for now, is sustaining. I think that's what's been driving things.
And so, Stacy, as we think about growing into some of these valuations, I mean, what are these companies going to have to show that they can do in order to grow into the lofty numbers as we've been discussing?
Well, I mean, so be careful, like lofty numbers, lofty valuations are two different things. Not all of these companies are expensive, right? You can look at a company like Nvidia, it's actually quite a bit cheaper today than it was before the run started, you know, a year and a half ago. Because as much as the stock has gone up, the earnings estimates have gone up far more than that. And so that becomes the question, like, are the earnings actually achievable? I mean, they need to clearly the numbers need to go up. I mean, I would say that, you know, given where the sell side numbers are, the buy side numbers are going to be even higher than that. And so any kind of increases we can see to customer spending, any sort of clarity we can get on business models, what are they actually doing with this spend is helpful. And I would say, at least in the near term, what we're hearing from that supply chain and from the customers is constructive.
And so on the customer side, or at least on the demand side, I should say, is what we're hearing strong enough to sustain this long term, the growth? At least it seems like all of these companies, as they're talking about the demand that they're seeing, when they're on these calls and saying, well, the demand is strong, so we're just going to keep building it out, keep investing in it.
Yeah.
And so
I mean, that is what we're seeing right now, right? And there's also a little bit of, you know, they're kind of in a fight right now. I mean, I think Google had suggested, what did he say? He said that, you know, the risks of underbuilding were a lot bigger than the risks of overbuilding right now, right? And so, because they can use the capacity for something else if they need to, and they've got tons of money, right? This is one difference versus say 2000. These companies are incredibly well funded, and very profitable. They can afford to spend right now. But I think you're getting the heart of it. This is the controversy on some of these names. It's you know, like the worry that just these guys tend to build and digest, and is there a digestion cycle coming on? And at some point maybe, but it clearly is not now. Like, I'm not really worried about it this year. I'm not really worried about it next year, given some of the product cycles and everything we've got. 2026, I don't know. I also, though, am very bullish on the long-term opportunity. I still think in 5 years or in 10 years, we will be talking about numbers that are materially higher than what we're talking about today. These things are never straight lines. But I do think as we're going along, like over the next like several years, it's up. I think the opportunity, the numbers we will see will be up.
Interesting. 2026 potentially the big test.
I mean, I don't know, right? I mean, at least for now, for this year, probably for next year, I think things are fine. I think the spending is going to continue.
Yeah, I mean, you've got the modeling, Stacy, so we enjoy these conversations with you and getting your insights and perspective. Stacy, thanks for joining us this morning.
You bet.
Certainly. Stacy Ragson, who is the Bernstein Managing Director and Senior Analyst.